In last topic, we had a close look at venture capital and leverage buyouts. In this topic, we will take a close look at the other two private equity strategies. They are mezzanine financing and distressed debt. Let's first look at mezzanine financing. What is mezzanine financing? It generally refers to financing has the characteristics of both debt and equity. It is located in between normal equity and senior debt in a company's capital structure. This is where the name of mezzanine financing comes from. So mezzanine financing is senior to equity but subordinated to senior secured debt. Mezzanine financing can take the form of debt or equity. If it takes the form of debt, it is often in the form of an intermediate term unsecured bond with a stock warrant attached to it. The stock warrant gives the investor the right but not the obligation to purchase the borrowing money's shares at a predetermined price by a predetermined time. The stock warrant enables investors of mezzanine financing to share the upside potentials of the borrowing company, just as normal shareholders do. However, at the same time, they have more protection and more stable cash flows than normal shareholders as a result of the debt component of the investment. Mezzanine financing can also take the form of equity. If this is the case, it is normally in the form of preference shares, which can also be converted to ordinary shares later. It also lets investors share the upside potential and at the same time enjoy more protection and more stable cash flows as offered by preference shares. Then when mezzanine financing will normally be used, it can serve to make up the time gap in a company's financing. For example, there may be a time gap between the last round of venture capital financing and the IPO of startup companies. Mezzanine investors can make up this time gap by providing finance. By doing this, they are able to share the gains from the potential IPO, but bearing much less risk than venture capital investors, because start companies close to an IPO is already quite established with much less uncertainty involved. Mezzanine financing can also serve to increase a company's borrowing capacity for senior debt and therefore decrease a company's financial constraints. As we already know, mezzanine financing is subordinated to senior debt. So from senior creditors' perspective, there is no big difference between mezzanine finance and equity, as they are all subordinated to senior debt. Therefore, using mezzanine financing can decrease a company's leverage in the eyes of senior creditors and make them more willing to lend money. This is particularly useful when a borrowing company does not want to issue more shares to decrease its leverage. Mezzanine financing may also serve as a source of finance for leverage buyouts and increase the borrowing capacity of a buyout when a leverage buyout cannot raise sufficient capital to complete the deal. Because of the debt component, mezzanine financing is expected to be less risky than venture capital and leverage buyout in the private equity category. However, the return is also expected to be lower. The correlation between mezzanine financing and the traditional financial assets has been observed to be low. So including mezzanine financing into your portfolio may improve portfolio diversification. Next, let's have a look at distressed debt. What is distressed debt? Distressed debt is debt issued by companies who are in financial distress or in danger of bankruptcy. When a company is in financial distress or close to bankruptcy, the price of its debt will be very low. Sometimes distressed debt is simply a bargain in the eyes of private equity funds. If they believe these companies are in trouble only because of some problems that can be fixed and the troubled situation is only something temporary. Market for distressed debt tend to be very illiquid and inefficient. Because the market is very illiquid and inefficient, it is very likely that distressed debt securities traded in the market are not priced properly. And here is the opportunities for private equity funds, and this is where the big gains comes from. Some distressed debt investors will be highly involved in the management and reorganization of the distressed companies in their portfolio. However, some investors simply buy distressed debt that they believe is undervalued and wait for the price to go back to its fair value. For a distressed debt investment, if the favorable event happens and the distressed company gets out of the troubled situation, then the distressed debt investor can make a lot of money. However, if the unfavorable event happens and the troubled situation cannot be turned around, the investor may lose a lot of money. As the company is already in trouble, the chance of the unfavorable event is actually pretty high. Distressed debt can be considered as similar to high-yield bonds, but with high risk, as the company is already in trouble. Therefore, we expect to see higher returns, higher risk, and more exposure to extreme events from distressed debt investment than high-yield bonds. The expectation actually is proved by historical data. The correlation between distressed debt and some traditional assets has been observed to be low. Therefore, including distressed debt into a portfolio may improve portfolio diversification.